Recording in progress.
Good morning, everyone. Welcome to today's session. Today is Saturday, the 29th of May, 2021. And today we'll be discussing on some areas of the standards that is going to guide us in the whole process of ensuring that we present financial report that is compliant with the International Financial Reporting Standard, which will be useful for decision-making by various stakeholders and for various purposes. Now, today we'll start with accounting for inventories, okay, and we'll be discussing in light with IAS 2. And we are going to ensure we demonstrate practical understanding of these critical transactions in the course of business operation and how we account for this and how this is equally presented. We are going to look at all of this in the course of our discussion. Welcome to our discussion today. And in the whole process of our discussion, we'll try to identify various forms of inventory, starting from inventory that more or less involve buying and selling, which means inventory of stock that is already at its finished state in usual cases. And we can also look at inventory from the perspective of a manufacturing company, where we'll have various categories of inventory spanning from raw materials to work in process and up to finished goods and to some extent consumables. All of these are what we are going to consider. Also, we are going to consider what is the aggregate cost of an inventory, starting from the purchase price to other incidental costs, including cost of conversion of those inventory to its rightful state to which it can be used in further production or for sale. We are equally going to look at various cost methodology or inventory costing techniques in line with the requirement of IAS 2. And therefore, we'll be looking at issues that put us on first in, first out, weighted average methodology, and specific identification. Okay, and we are all aware that the requirement of IAS 2 forbids last in, first out. But we are still going to look at what last in, first out means, and probably why it might have been more or less precluded from use by IASB. And also we'll look at measurement of inventory at each reporting date, though the basis or the basic foundation for measurement of inventory is the cost. That's why we earlier more or less pointed out the discussion we are going to have on aggregate cost of an inventory. But as time goes on, we understand that where it seems that the net realizable value, okay, which is the selling price of inventory less a disposal cost or any selling expenses, when it falls below the value of the cost of the inventory, we're jettisoning the cost by trying to recognize the write down in the value of inventory, thereby substituting the cost for the net realizable value. And that's why, in summary, we usually say in the field of accounting that inventory should be measured at the lower of cost and its net realizable value. We're going to look at disclosure requirements and some other things in the course of this discussion. And I believe at the end of the day, we'll be able to make justice to that. Okay, and before we commence, I would want one or two persons to make commentaries about the expectation and what you've come across in the past and what you tend to take out of this discussion, if any. Over to you guys.
Good morning, everybody. Thank you very much, Mr. Muyiwa.
Yeah, about inventory, we've done a lot about inventory in ICANN and also when I was still an auditor. But my expectation for this is that I really want to know more about it, because when I was in BDO as an auditor, as a trainee auditor, I didn't have the opportunity to audit inventory because it's always reserved for the more experienced people, especially the senior auditors. All we did then was just around stock count and all those things and other financial statement areas. But I see this as an opportunity to actually learn and know what exactly they do in inventory, and maybe it will be helpful going forward in my professional career. Thank you.
Okay. Thank you.
Good morning, everybody. Welcome once again. As inventory is concerned, it is not a new concept. It's something that I am familiar with, but unfortunately, the nature of my current job did not give me opportunity to actually work around inventory. To be honest with you, I learned it during my ICANN preparation stage, but I don't really know much about inventory and how we deal with handle inventory when it comes to practice. I think my expectation is to know uh, the reality about how to handle inventory in practice, especially the requirements of International Financial Reporting Standard as per inventory. Thank you.
Okay. Thank you very much, guys. Let's continue with our discussion. Okay. Now, the first point is to look at what is the scope of IAS 2 with respect to inventory. And thereafter, we'll move on to having better appreciation of how do we go about doing the needful. Okay. Okay. Give me 1 minute. Okay. Now, let's start from the scope. Okay. The scope of IAS 2 deals with all forms of inventory excluding these two items. One, biological assets. In our next session, we'll discuss on biological assets and why it's somewhat scope out of IAS 2. And the second one is financial instruments. Example, when you deal with bonds, shares, and the likes. Okay? When you own those items, they are not inventory for the purpose of accounting. Rather, they'll be treated as such as financial instruments, similar to biological assets. Okay, that is that. That's the first point of call. Now, when we say inventory, what do we mean by inventory in its first instance? Now, inventory connotes one that it is an asset, attributes of inventory for the purpose of our discussion.
One is that it meets the definition of an asset. Inventory is an asset. Two, inventory is a form of asset that is held for sale in the ordinary course of business. Now, we'll define what ordinary course of a business is. The third thing about is that it could also be something that is in use in a production process. Or it could be in the form of materials or in form of supplies to be consumed in the production process or in rendering of services, which means this slide deals majorly with what we call consumables, which means when you find these attributes embedded in an asset, when you find this attribute embedded in an asset, we see such asset to be considered as an inventory. Now, do we really know what inventory is merely by looking at this definition? Let's give example of inventory and let us critically examine them, whether they really qualify as inventory. I need examples from you guys.
Inventory of materials.
What do you mean by inventory of materials?
Okay.
I need those items.
Okay. Example of inventory can be cars acquired for sale.
Okay, cars purchased or produced for resale. Okay.
Okay. Real estate.
Real estate.
Yes.
How can you consider real estate as inventory? From what perspective? Let's discuss it.
Yeah, for instance, if you are into building estates for sale, then you can consider that as inventory.
Okay, first, you generalize it by saying real estate. Real estate does not necessarily mean you build to resell. You might build to let out.
Yeah, that's
You
true.
might build for the purpose of capital appreciation. Therefore, we need to understand the perspective. But from your explanation, it seems what you refer to is properties constructed for resale, rather than generalizing it by way of real estates. Okay.
Okay.
All forms of stock of items for what? Resale or use in production of other goods or rendering of services. Again, I think Anne wanted to make comments.
Yes, what I was going to say is in this third line that you just put, all items for use in production. I was going to say flour for making of bread, and I think it's inside this third example.
Okay.
Okay, I
Who
also want
else?
to include another thing under this third one, which is inventory of tools and spare parts.
Okay, that means you are talking of consumables. Consumables, e.g., minor, you have to be careful, minor spare parts, because there's a thin line between inventory and PPE when it comes to spare parts. And today also we are going to discuss another section where we'll discuss on accounting for property, plant, and equipment, where we can see the thin line between minor spare parts, which we consider tools, do you get what I'm saying now, that forms point of consumables or small items. Okay. Now, I'll now put lastly, harvested agricultural produce. I've qualified the word harvested. And tomorrow we'll deal with IAS 41 on agriculture and biological assets. We understand the thin line in that regard. Any other perspective? Okay. Now, which means inventory by definition is not more or less, how will I say it? It's not limited to issue of the nature of that item. It's a function of the purpose of holding such an item. Is this something that you hold to immediately resell in the normal course of business? Is this something that you require as an input into a production process, or that will aid you to render services to another person? That constitutes what we call inventory for these purposes. Any other question? Now, how can you distinguish these categories of inventory? Raw materials, work in process, which some people may call work in progress, finished goods, merchandising stocks, and consumables. How do you distinguish between this? We have more or less agreed that all of these constitute an inventory, but how do you distinguish them? What is raw material?
So I think I should just give it a try. Okay, raw material, I think are the materials you feed into your production process. You know, you get them from maybe third party or whatever. But work in progress is the raw material that you've already worked upon, like that have passed through some sort of processing within your organization. And finished goods is the outcome of that raw material that have passed through various processing by your organization. And you know, your own raw material might be another organization's finished goods, and your finished goods could be like a raw material to another organization. Merchandising stock, I think they are the stock of items that you purchase for resale. The ones that you purchase, maybe finished goods that did not go through any processing by you, but you purchase them for the purpose of reselling them to your customers. Consumables, they are the items that you used on a daily basis within your organization, which are not necessarily related to the previous four items that I mentioned. For instance, consumables could be toiletries and whatever that are not really related to the business activities.
Okay, now I think you've given a fair trial, and I'll share this with us, and I want somebody to look at it. Who will take us through this? Let's look at this perspective from what we have here. Let me try and enlarge it. Okay, can somebody take us through what is the distinguishing factors between all of this? And one thing I want you to take note of is that it must be from the perspective of an entity. Therefore, it's not something you generalize, okay? Which is what one of the closing remarks made by Shegun, which means from another entity perspective, what you consider finished goods might be raw material to them. And likewise, what you consider as raw material might be finished goods from somebody else. Okay, who will guide us through in this?
Okay, I will read. Raw materials. This type of inventory includes any goods used in the manufacturing process, such as components used to assemble a finished product. Raw materials may also include partially finished goods or materials. For example, for an orange juice company, oranges, sugar, and preservatives are raw materials, while for a computer manufacturer, chips, circuit boards, and diodes are raw materials. Inventory items may be classified as raw materials if the organization has purchased them from an outside company, or if they are used to make components. Work in process. Work in process inventory items are those materials and parts that are waiting to be made into something else. These may include partially assembled items that are waiting to be completed. Work in process inventory items may include finished goods that have not yet been packaged and inspected, as well as raw materials that have moved from storage to a pre-assembly area. For example, in an orange juice company, the oranges may come into a storage area where they are raw goods, but once they have been moved out of the storage area and onto the assembly line for juicing, they become work in process inventory. In a small company, work in process goods may be stored in the same area as raw materials and finished goods. Finished goods. Finished goods are any product that are ready to be shipped out or sold directly to, to customers, including to wholesalers and retailers. Finished goods may be waiting in a storage area or on a shop floor. If the amount of inventory of finished goods increases faster than the amount of raw material, raw goods, and work in process goods, then production may need to slow down until more finished goods are sold. In some businesses, goods are not included in the finished goods inventory until they are sold. For example, a company where goods are made to order. Other types of inventory: maintenance, repair, and operating inventory are all the items an organization needs in order to operate, such as office equipment, packaging boxes, and tools to repair equipment. There are also other types of inventory that are classified based on the purpose they serve. These include transit inventory, which are products or components that are being moved from one location to another, such as from a whole house to a factory. Buffer inventory, which are excess inventory items that are kept on hand to protect against supply problems, such as poor quality or slow delivery or raw materials. And anticipation inventory, which are items that an organization stocks up on in case of excess demand, such as in the build-up to Christmas shopping.
Okay, thank you very much. Thank you very much. And please just take note of this buffer inventory. We are going to discuss it later, okay? But just take note of this buffer inventory. Yeah? We'll look at that. Now, that is that from that perspective.
Please, I have a question, sir.
Okay.
For instance, when you hold a third-party items or products, for example, Amazon or Jumia, that they also use their platform to sell for other companies, and these are not their products, these are not produced by them. So do we also classify those ones as inventory, or how do we classify them?
Okay, that's why if you get back to our definition here, this attribute is very key in the whole of those process. But where you are going to is a specific area with respect to sale on return basis, or what we call consignment goods. Okay, and the question is the substance of the transaction rather than the legal form is what is critical in justifying whether it constitutes inventory or not. Now the question is this: if the nature of the transaction is such that you only provided storage and access to markets on behalf of the real producer of those items, it may not constitute inventory in your books. I get what I'm saying now.
Yes, sir.
Okay, for it to be inventory in your books first means that you have taken ownership by way of control. Once control has moved to you, do you get what I'm saying? That means you have an obligation on it. And in that case, it might constitute inventory. But once control is deemed not to have passed to you, on the premise that they only use your warehouse for display, and that item is more or less seen to be, it's like having a workspace or workstation where people can co-share office space. And in this slide, what has happened is that I, as Amazon, has provided warehouse where anybody that qualify based on my assessment can come and display his goods. Even though people see it as Amazon warehouse or Amazon store, but practically those stores are partitioned in a manner where individual owners of those products still have control of those products. And in that case, it won't be inventory to Amazon, but rather inventory to the original producer or seller in that case, which means it is not a straitjacket answer. It's for you to look at the whole economic substance and the commercial relations in that kind of arrangement before we can consider it as an inventory. Okay. Because if you consider it as an inventory, it then means that you must have parted away with cash, or you must have assumed a liability for it. Which means if you part away with cash, it means you paid for the item and it becomes your inventory. Or if you have not paid for the item, it means you have a payable to a vendor that supplied you those items. But if it's like a consignment goods or goods on return basis, it then means that you will have only taken it as a memorandum inventory. A memorandum inventory is that you are just keeping track of it on behalf of somebody else who actually has control over it. Does that make sense, please?
Yes, absolutely.
Yeah. Any other question, please? I want us to make it as practical as possible, rather than just come to discuss IFRS says inventory is lower of cost than net sale and everybody walk away. You understand? These are the practical stuff we could engage ourselves with in this slide. Okay, now the next phase of our discussion on this is to look at how do we, okay, before then, let me highlight it here. Buffer. What we call buffer stock. Okay, we'll come back to that. Okay, but now you know what inventory is. The question then is, how do we measure inventory? At the point of initial recognition, at initial recognition, how is inventory measured? And the answer is very simple. It is measured at cost. The next question then is, what constitutes cost of inventories? Now, the cost of inventory in this slide can be grouped into three. Inventory cost, can be grouped into three. The bulk part of it is the purchase cost. The second part of it is the conversion cost or cost of conversion. And the last part of it are other incidental costs. Now, what is purchase cost in its real sense? Who can tell me what purchase cost is in its real sense? What is purchase cost? Now, let me continue my discussion. Purchase costs include one, the purchase price, which is the price you pay. The price you pay at the point of acquiring the inventory, okay? Whether in its raw form or in its finished state. And this is net off trade discounts or rebates. Okay. Now, the word trade discount distinguishes from any other form of discounts. Okay, we have two common types of discounts, trade discount and cash discount. Who can tell me the difference between the two? The difference between the two. Trade discount and cash discount. What's the difference?
Let me try. I think cash discounts is the discount granted to customers who are willing to purchase and pay immediate cash. While trade discounts are the discounts given to the customers who are willing to buy a specific quantity specified by the sellers of the item. That's
okay. Trade discounts, this with discount given to incentivize buying more quantities. Okay, that is to encourage you to buy more in any form. It could be buy 5, get 6. It could be if you buy more than 5, we'll reduce your price by 5%. Any form of things to more or less encourage more buying from the perspective of the buyer is what we call the trade discount. Okay. Why cash discount is much more of encouraging people to pay promptly. It has nothing to do with increasing your quantity sold, but it has something to do with your collection and reducing your bad debts or delays. I get what I'm saying now. And that is what that implies. Does that make sense? Now, why I'm emphasizing this is because the requirement of the standard is that it is a trade discount and not the cash discount that will be deducted in the course of determining the net purchase price. Does that answer our queries now? Now that is that. Another thing that you consider in your purchase cost is any form of import duties and other levies relating to the acquisition of that asset, which in this case is an inventory. Another thing you consider is transportation and handling costs directly attributable to the acquisition of the inventory. Whether in its raw state, in its in-process state, or in its finished state. That is part of it. And if you remember those days when we started basic accounting, we call them carriage, what's it called? Carried inward, as the case may be. You understand? Carried outward is not integral part of the cost because it is not a cost directly attributable in the acquisition. Rather, it is a cost incurred in ensuring that we subsequently move it in different locations for the sole purpose of selling or into further production or process. Therefore, we need to take note of that. Okay, now take note. In this aspect of import duties and other levies or taxes, these are considered non-refundable taxes. They are considered what? Non-refundable what? Taxes. When we consider all of this, we are able to determine in aggregation our purchase costs. Now, what is our conversion cost? Our conversion costs include one, costs that are directly related to the units of production, e.g. And this conversion cost is required when you are dealing with stock of raw material, which you have to take into production process. And this includes direct materials, direct labors, and any other form of direct expenses other than production overheads. Why, secondly, other than the direct costs, you also have indirect costs, which are known as overheads. And these overheads may include those that are fixed production overheads and variable production overheads. And these overheads will be in tune with your system that has been adopted in your manufacturing setting or production setting, be it marginal costing techniques or absorption, full absorption costing techniques, okay, which we'll have done in performance management or what people call costing, cost accounting, or managerial accounting. Okay, these are, and this only is required when you are dealing with non-merchandising inventory, which means you are dealing with inventory that arose from production process. Okay. Any question before I move ahead? Now, I'll give you a clue here.
Please,
for
I want to
better
pick one
appreciation.
question.
Yeah.
Yeah, like, all those, okay, maybe you call it other incidental costs now. In Nigeria business environment, you pay a lot of money that are not directly related. For instance, now if you have to bring a container from Apapa or something to wherever, you have to pay a lot of people along the line. How do we classify those money and also some bribe and other things that you pay?
Okay. I think I'm much more in tune with your first expression with cost you incur in Apapa and also of things. Those ones probably when we get to the third category, we can consider them as incidental cost to bring in that inventory to its present location and condition. Okay. But the last one you mentioned, I'm not much more familiar with that bribe. Do people pay bribe? Okay, probably you might see that as community expenses or business development, but I'm not used to bribe. I'm not familiar with that. Probably that's what you meant, like, okay, you just want to appreciate people for being part of your stakeholder or part of your investing community. Okay, I think so. Okay, we'll see that as we move on. Thank you. Okay, now to further buttress my indirect cost or what I call overhead, I told you it could be fixed and it could be variable. Okay, fixed production overhead are those indirect costs of production that remain relatively constant, regardless of the volume of production. An example of that is where you have cost of factory management and administration. Factory labor costs and some form of factory allocated costs are part of cost of product rather than part of your operating expenses. Okay, and that's what we try to reflect here. And those that are not fixed, that is, they move or they change with level of activity, though their indirect costs are what is termed variable production overheads. And those are indirect costs of production that raise directly or nearly directly with the volume of production, e.g. indirect material and labor cost. When you have casual workers, okay, their costs are more or less going to be absorbed based on the production contribution. Okay, that is that. But again, we need to also drill down and look at fixed production overheads to see whether it's in all cases that all fixed production or all kinds of fixed production overhead are integral part of what should be absorbed as part of cost of conversion. And on that premise, I'll take you further to look at this. I want somebody to read this for us. Anne, can you read this for us?
Fixed production. Fixed production overhead must be allocated to items of inventory on the basis of the normal capacity of the production facilities. This is an important point. A, normal capacity is the expected achievable production based on the average over several periods or sessions or seasons under normal circumstances. B, the above figures should take account of the capacity loss through planned maintenance. C, if it approximates to normal level of activity, then the actual level of production can be used. D, low production or idle plant will not result in a higher fixed overhead allocation to each unit. E, unallocated overheads must be recognized as an expense in the period in which they were incurred. F, when production is abnormal high abnormally high, the fixed production overhead allocated to each unit will be reduced. So avoiding inventories being stated at more than cost. G, the allocation of variable production overhead to each unit is based on the actual use of production facilities.
Okay, thank you very much. Now, what this is trying to tell us is this, is that the word fixed overhead, not necessarily all of it will be absorbed into cost of conversion or into what we call the product costs. Some of it will be considered period costs. What is the difference between product cost and period cost? Who can give us guidance? Product cost and period cost, because you all know that part of production overhead costs can go into period cost and some can go into product cost. What is the difference between the two? Who will assist us? Who will assist us?
Hello, sir. Let me try, sir.
Okay.
So I think if we say product cost, that a product cost should be a cost that can be directly attributable to the unit of the inventory. Meanwhile, I feel if it is a period cost, it will be a cost that, though it is for the inventory, but it can be specific to a particular length of time. So I'm trying to make an example, for example, a factory or maybe a warehouse cost for a particular period of time can be said to be a period cost because you may not directly attribute it to a unit of the inventory.
Okay, who else? Who else?
Okay, let me ask you something. For period cost, I think is the cost that is being expensed is incurred for that period and at the same time expense in that same period, as the name implies. Then the product cost is the cost attributable to that particular item. That's the cost you incur in getting that product. That's what I can say about it.
Okay, who else?
Okay, let me just like add to it. Like I want to agree with the first speaker, Asama. Like product cost could be the cost you can directly attribute to a unit of production. For instance, the cost of factory workers, you can easily say this is the cost based on the number of products that each worker was able to produce. Whereas period costs are those that you cannot really directly link to unit of production. For instance, maybe a factory manager, you cannot link it to a number of product units. It could be based on the number of time, how long it was supervising the project or the production. So that is just my addition to it.
Okay, I'll share a video with us now, and that probably will assist
In this
us
video, we're going to talk about the difference in product costs.
Okay.
and period costs. So this distinction between product costs, in this video, we're going to talk about the difference between product costs and period costs. So this distinction between product costs and period costs only makes sense for manufacturers, retailers, or any company that has inventory. And it's really a matter of timing. When is a cost going to be expensed? So product costs are costs that are assigned.
Can you see it?
No.
No.
Okay, I'm coming.
In this video, we're going to talk about
Okay, my video is not displaying here. I don't know why. Okay, I think it's not displaying. Can you see it now? Can you guys see it now?
Yes.
Okay.
In this video, we're going to talk about the difference between product costs and period costs. So this distinction between product costs and period costs only makes sense for manufacturers, retailers, or any company that has inventory. And it's really a matter of timing. When is a cost going to be expensed? So product costs are costs that are assigned to the company's inventory account. So they're going to go to the balance sheet. They're not going to immediately be expensed. So if we take a manufacturer, we're talking about costs like direct materials, direct labor, manufacturing overhead. These are all manufacturing costs. In manufacturing costs are product costs. They're going to be assigned to the company's inventory account. They're going to be capitalized. They're going to show up on the balance sheet. But when that manufacturer actually sells the inventory, then it is going to expense all these costs through cost of goods sold. A retailer, conversely, when they purchase inventory from a manufacturer, they're going to have an asset account called inventory, and that is capitalized. All those costs of acquiring the inventory, But when the retailer sells the inventory to a customer, that's when they're going to expense those costs through cost of goods sold. Period costs are just costs that are not product costs. It's all the other costs, and they are expensed when they're incurred. An example would be selling general and administrative expense. So let's say you have sales commission. Okay, that's an example of a selling expense. You just when in the period when you incur the sales commission, that's when you expense it. It doesn't become part of the company's inventory account or anything like that. So let's get in a little more depth with an example. We'll say we're doing a manufacturer. Let's say the company Tesla. Okay, Tesla is a manufacturer. Okay, so we're going to use them. And remember, I said any manufacturing cost is going to be considered a product cost: direct materials, direct labor, and manufacturing overhead. But let's get into some specifics. Let's do a couple examples. So if we have, let's say, the wages, so whatever we're paying to a janitor, the question is, okay, is that going to be a product or a period cost for Tesla? If there's a janitor and they're paying them, let's say $15, $20 an hour to do some cleaning, well, it depends. It depends. What are they cleaning? If the janitor is cleaning the factory, okay, anything related to the factory is where the production is done, right? That's where Tesla produces vehicles, batteries, and so forth. So any wages related to a janitor cleaning the factory, that is going to be considered a product cost, okay? Specifically, that's going to be manufacturing overhead. So whatever they pay the janitor, let's say they pay the janitor $400, okay, that is actually going to become part of inventory. So that's going to become part of inventory for Tesla, and then it's going to get attached to the inventory, and then when the inventory is sold, it's going to be expensed through cost of goods sold. Now, same company, Tesla, let's say, a manufacturer, and we've got a janitor who is cleaning the marketing department. Okay, if they're cleaning the marketing department, that is going to be a period cost. Even though Tesla is a manufacturer, its marketing department is not involved with manufacturing the product. Okay, so these costs of paying the janitor, if you pay the janitor $400 for some work related to cleaning the marketing department or the accounting office or HR, something like that, it's not a manufacturing cost. It's not related to the factory or manufacturing the product, so it's going to be a period cost. So this $400 is not going to go to inventory. You're just going to expense it and just say, okay, wages expense and so forth. Okay, another example would be if we have at Tesla a production manager, and let's say that they're getting paid $100,000 a year. So that salary is going to be a product cost. Okay, this is a product cost because they are the production manager. They're in charge of overseeing production. This obviously has to do with manufacturing. Okay, so this cost is going to end up in inventory. It's going to get attached to the products. That's why product costs are also called inventoriable costs. And then eventually when the product is sold, it's going to go to cost of goods sold. But if we're talking about the salary, so again, same company, Tesla, manufacturer, we're talking about a salary of $100,000 paid to an accounting manager at Tesla, then we say, okay, you know what, that's going to be a period cost. Even though Tesla is a manufacturer, still accounting, the performing of accounting services for Tesla, that is not a manufacturing related function. So this accounting manager, their salary, when we owe them the $100,000 and stuff, we're just going to expense that in the period that it's incurred. It's not going to become attached to inventory or go through cost of goods sold.
What is a product cost versus a period cost? Let's discuss the accounting concepts product cost and period cost with some easy to understand examples. We will do high-level cost accounting for a hypothetical company called Toy Giraffe Inc. As the name suggests, this is a company producing and selling toy giraffes. We are going to classify various types of cost as either product costs on the left or period cost on the right. Product costs include all the costs that are involved in acquiring or making product. Product costs are viewed as attaching to units of product as the goods are purchased or manufactured. Period costs are expensed on the income statement in the period in which they are incurred. First type of cost, marketing expense. To determine whether this is product cost or period cost, we ask ourselves whether we can stick these costs to the giraffe. Marketing expense is a clear example of period cost. period costs are not a necessary part of the manufacturing process. As a result, period costs cannot be assigned to the products or to the cost of inventory. How about depreciation? The answer here is, it depends. The company has two areas it depreciates: manufacturing depreciation for the factory and machines it owns, and depreciation on the office and its equipment. Depreciation expense for factory and machines is in product cost. Depreciation for the office is in period cost. Factory labor. This is clearly a product cost. Stick it to the giraffe. You need people in the factory to make the product. Utilities. Electricity, natural gas, water. Just like with depreciation, it depends. If we know how much electricity was used in the factory versus in the office, we can split the total utilities bill. We allocate what was used in the factory to product costs, and we allocate what was used in the office to period costs. Raw material used in production. This is clearly a product cost. You need raw material in order to assemble the product and turn it into finished goods. Research and development expenses for the next generation toys. This is a period cost. It doesn't stick to the product. We could go on and on with other types of cost, but I think you are getting the idea now. After classifying the cost as either product cost or period cost, we can take the next step in our cost accounting. Let's deal with the product cost first. We produce 100,000 units in Q1 at a total manufacturing cost of $500,000. Of these 100,000 units, 50,000 are sold in Q1, with cost of goods sold of $250,000. Cost of goods sold, in short COGS, refers to the product costs of those goods a business has sold during a particular period. The other 50,000 units go to inventory for future sales, at cost, $250,000. Inventory is an asset on the balance sheet. This is why period costs are sometimes called inventoriable cost. They remain attached as the goods go into inventory awaiting sale. Now that we have parked half of the product cost on the balance sheet, let's review the income statement. On the left are the toy giraffes that have been sold. This is the product costs of those units that have been sold, 50% of the total for each category in Q1. This is called cost of goods sold. On the right are selling, general and administrative expenses, SG&A, and research and development. We take our sticky notes from earlier on and place them in the appropriate area. Or in a more formal look on the income statement, cost of goods sold is right here near the top. If you take revenue and deduct COGS, you get to gross margin. SG&A and R&D are placed as a line item a bit lower in the income statement. If you take gross margin and deduct SG&A and R&D, you get to operating margin. I hope you enjoyed this short discussion of product cost versus period cost. If you enjoyed this video, then please give it a like. On this end screen there are a few suggestions of related videos you can watch next. Please subscribe to the Finance Storyteller YouTube channel. Thank you.
Now, I believe we have a clarity now. Do we have clarity?
Yes.
Okay.
Yes.
Okay. Now,
Yes, sir. Quick question, sir.
okay.
Can we say all period costs are indirect costs?
Okay, no, you can't say all period costs are indirect costs. But what we are trying to say is that period costs are costs that cannot be traced to, whether traced directly or indirectly to the production itself, which means they are costs that probably with or without producing those specific units by way of batch or by way of job or by way of order, such costs will still be incurred. For example, administrative expenses, to some extent, whether you are increasing your production or your production is reduced, it still doesn't change the cost structure of such an expense. Are you getting what I'm saying? That's why we said such should constitute part of your operating cost rather than product costs, which will have gone into your cost of goods sold. Does that make clarity now? Okay, and
it's clear, sir.
Yeah, okay. Now that's why we said here that any unallocated overhead by way of product cost will be treated as period cost, and such cost will be expensed, okay, in the period they were incurred. And any overhead that is attributable to abnormal activities or wastages will not necessarily be considered as part of product cost. Do you get what I'm saying now? And that's why we consider such as being expense. That's why you have what we call abnormal loss. Abnormal loss is not always absorbed as part of product cost. It's just operational loss, which is expense. Okay, and that is that. Okay, now let's look out for what my brother said earlier, other incidental costs. Also, other incidental costs are any costs that should be recognized if they are incurred in bringing the inventory to the present location and condition. You know, if you look at this study, the case study of Apapa in Nigeria, all of those things you have to do to get your product out of Tinkai Island and also of things are logistic costs, and therefore they are incidental costs, which include transport and handling costs. If you remember, yeah, I make mention of transportation and handling. Now, if you come here, it might even not come under that if you can specifically trace it to transportation or handling, it will come under purchase cost. Okay? If not, if it's just generic in nature, it will come under incidental cost. And incidental cost will include abnormal amount of wastages of labor that is abnormal to a certain extent, okay, not abnormal in its entirety, storage costs, except costs which are necessary in the production process further in another production, and it includes administrative overhead not incurred to bring the inventory to this. Therefore, the standard says that the standard list type of cost which will not be included in cost of inventory. Now, this incidental cost is any other cost that cannot fall under conversion costs or purchase costs, but they must not include the following. And I'll give you reason one by one. Abnormal costs, I've told you that it goes by way of operational loss. Abnormal cost is treated as operational loss and its expense charged to profit or loss immediately. Storage cost, okay? This storage cost, once you have brought your inventory to the state or to the point to which it is available for sale, such cost will not be considered part of product cost, okay? Except if that cost was necessary in the production process before a further production process, which means such cost will be treated as part of working process. If you still need to convert that that product in that storage to another further production process for finished goods or other form of output. Okay, and in that case, that also will be expensed directly in profit or loss. Now, administrative overhead, okay, not incurred in bringing the inventory to the present location, which means this administrative overhead are those that are attributed to things like marketing, things like accounting services, and etc. All of these are treated as period cost. And selling cost is not considered. Where it is considered is at the point of measurement, where we are comparing costs with net realizable value, or because net realizable value is considered as the fair value of the inventory less cost to sell or cost of disposal. And that is where selling cost is relevant. It's not relevant in determining cost, but it's relevant in determining the net realizable value. And we'll come to that level soonest. Any other question? Any other question? Okay, in the absence of no question, now, what are the cost formulas that we have? We have various cost formulas, okay, but the one that is recognized or allowed by IAS 2 are 3 in nature, or I will group it into 3. Okay, the first cost formula allowed under IAS 2 are as follows. 1, FIFO, which means first in, first out. 2, weighted average. 3, specific identification price. Now, what are the differences between these? Take note. Let me emphasize it in red. Note. LIFO, which is last in, first out, is not allowed under IAS 2. Let's take note of that. Okay, when you hear first in, first out, what does that signify? First in, first out, what does that signify? Who will assist?
Okay, sir. I believe first in, first out implies that the products that comes to the organization or that were produced first should also be sold first before the latest products. That is my simple understanding of first in, first out.
Okay. Who else? Who else?
Yes, I agree that first in, first out is the principle of charging the first inventory that based on the period of entry into the inventory calculation, charging out that first before the current set of stock. I don't know how to say that.
Okay. Okay, how does that differ from last in, first out?
Last in, first out is accounting for the latest stock in the inventory. unlike first in, first out that accounts for the earlier stock in the inventory.
Okay. What is now the significance of weighted average cost? What then is weighted average cost?
So weighted average is a term of aggregating the whole inventory over the weighting the cost of the whole inventory as charging the weighted average. What's the right word? Sorry. I mean, it's just considering the entire inventory, the cost of the entire inventory, on charging specific cost for either when it comes in or if it comes in early or is coming in later.
Okay. We'll look at it. What about specific identified price? Who can give us clue about that? Specific identified price. Okay.
I want to try. I don't know if I'm correct or not.
Okay.
I just think maybe when you select the price of a particular item of stock, regardless of when it came in, and you now use that price over you use it to value the entire stock. For instance, maybe you just choose at random, maybe the price in the middle or the one at one extreme or the other, depending on which one suits you, then you use that to value the entire stock. So I guess maybe that is what specific identification price means.
Okay. Now let me use this illustration to demonstrate our understanding of this. Okay, information on inventory of Infonomics Green Finance Limited. Okay, I'll provide some information. Okay. This information made available. Let's say this 2nd of January 2021. This 5th of January 2021. Now the activities are as follows. Purchase of items. We purchase the item at 10 naira. And the item purchased 1,000 units. Sold items out of store. We sold them at 14 naira. $600 out. Purchase another item at 11 naira, or let me say 10 naira, 50 kobo. Purchase another 400. Within these 2 dates, sold at 14.1. $300. So that's 15. 2. 400. We purchase on these dates another 500. We sold out of store. We purchase okay, this is our information, the way we have it. So it seems my system is banking, okay. Okay, now let's now use those methodology one by one. Let's start with FIFO. By date. And what's inventory? Okay. Now I'll start with the first item. The first item was purchased at 10 naira. The quantity was 1,000. Therefore, the cost price is the product of this, which is 10,000 naira. Okay. Now, on the 5th of January, items sold, quantity sold was 600. And first in first out means we have 1,000 items left. Okay, out of this 1,000 items, you sold 600, which means the 1,000 item to which you picked from was at 10 naira. Therefore, it means the cost price of what you sold out is 6,000 naira. At the end of the day, your balance in quantity is the difference between what you have as purchased and what you have issued out. Which means as at this date, you have not issued out anything. And likewise in your amount is the difference between your amount of what you have purchased and the amount of what you have issued out. Okay. Now the average price of it is 10 naira by dividing the kind amount with the quantity. Now, but as at this period, what is left is the difference between the balance brought forward and any addition made during the period less any item sold. At the end of the day, you have 400 left, okay, at what price? The price, the kind amount is the balance plus the kind amount here of the amount purchased less the amount sold. Now, what do we do? On the 7th of January, we purchased additional item at 10 naira 50 kobo. And how many units did we buy? We bought 400 units for 4,200, which means at the end of the day, we close to it 8,200, which means 400 left before plus another 400 make up 800, of which on the 13th of January, we issued out 300. And the question is, at what price are we issuing out? Remember that as at the time we are issuing out, we have only 20, that's 800 items. We have 800 items left before we issue 300, but this 800 can be broken down into 400 that was left after this 600, and another 400 that came in at 1050. But the word first in, first out means we must have sold this 1,000 in all before we can move into this 400. Which then means that out of this 1,000, 600 has been sold, leaving out 400. Therefore, I can sell 300 out of it, okay, at the same rate of 10 naira. And therefore, what will I do? I come here, I'll sell at that same 10 naira. And at that point in time, what do I have? I have 3,000 as my cost, which brings this to 5,200. Okay, as at 18th, I sold additional item. How many items did I sell? I sold 400. Okay, but this 400, you can analyze as follows. Remember, this 1,000 was sold out in range of 600 and 300, which means that there's 100 left from there. Plus this 400 is what make up this 500 we have. Now, of that 100 that is left there, I will sell 100 here, and I'll sell 200, which means what I can do here is to bring this down so that I can see what make it up. Which means what I can simply do is to say, that this 400 is broken down into 100 and 300. That's what I've done. Which means 100 that is left from here, from this 1,000, then put it in same color. And 300 is the difference between what was sold out and the 100 of the first batch. And therefore, I can link this in color to say this 300 is out of these items. I think my system is misbehaving. It's not allowing me to pick the color. Okay, give me 1 minute for me to reboot the system. It seems something is wrong somewhere.
Okay, comrade, excuse me, comrade.
Yeah.
Can I quickly ask something?
Okay, what's the question?
Okay. So my question or my concern, just help me with it. My thought is that for the principle of first out, for example, where we bought items of stock of 1,000 at 10 naira, and we have an amount of 10,000 naira, right? But at the time we are selling, my thought is that we will be selling at 14 naira. Why are we selling at the cost price?
Okay, what we are doing is we are valuing inventory, we are not valuing or determining revenue.
Oh, okay.
What is the cost of what you sold, which goes to cost of sales? Are you getting it?
That's clear, sir. Thank you.
Yeah.
Thank you.
Okay. I intentionally put the selling price there in order to provoke this kind of question, because people misconstrue revenue recognition to the act of
cost of sales.
What's it called? Cost of sales. Okay, inventory value and cost of sales. Therefore, I've restarted and I think it should be okay now. Okay, I think it's okay now. Now, which means the 300 is sold out of this 400. Okay, therefore, at what price? This is still at 10 for the 100, which is the last batch of that 1,000. And this is, okay, my screen is not shared, sorry. Now what I did is, this 100 is sold from the batch of this 1,000, that's the last man standing, okay? And it was sold at what price? It was purchased at what price? At 10 naira. Okay, this 10 naira is what is reflecting here. Okay, now out of the 400, the 300 is sold from this batch of 400. And in that case, at what cost was it? It was at 10.50 kobo. And that gives me my cost, which reduces my inventory value, which means at the end of the day, if you find out that the 100 left here is the difference between this 400 and 300 at the rate of 10.50 kobo, which is what it means. Now, as at 20th of June, I bought additional quantity at 10.45 kobo, which is 500. And that increases my inventory, of which on the 21st of January, I sold 300. And this 300 will have come from two batches. Batch one of it came from the balance here. Between this 400 and this 300, there's a balance of 100. Okay, let me show you the balance so that you know where the balance is coming from. This and this. And the balance here is coming from 400 and 300, which means this is the last batch there. And it's at 10 kobo. And remember, we sold 400. Out of this 400, 100 was taken from the batch of this, of green. And this 300 is taken from the batch of blue. Okay, and it then means that I'll pick the price from batch of blue, which is 10.45. And that is that. Now, the last purchases was made at the rate of 10.50 kobo. And the quantity purchased then was 200. Okay. Now, and the last item sold was 300. And this 300, if you remember, there's 200 left from this batch of blue, which means the 200 left from the batch of blue will satisfy first, which is 200 from the batch of blue. At what rate?
At 10 naira.
At 10.45 kobo. Therefore, the last balance we needed from that is 100 to make it up. Abi? And probably this will be batch of orange. Therefore, from the batch of orange, we needed 100 to make it up. This 300 minus 200 we have taken out of it goes to that. Okay, now, and that will be taken at a price of 10.50 kobo. Okay, and that is that. At the end of the day, okay, let me even change this to 10.55 kobo so that I can show different rates. Okay, at the end of the day, we've ensured that if we have not exhausted batch of yellow, we can't go into batch of green. If you have not exhausted batch of green, we can't go into batch of blue. If you have not exhausted batch of blue, we can't go into batch of orange. And that is what it means, which means at the end of the day, this is our inventory value. Now, if this is at the end of our period, this will be our inventory value as at the end of the period. Which means as at our reporting date, the inventory value based on first in, first out is these amounts. Does that make sense now? That is our value. Now that is first in, first out. Any question on that before we forge ahead? Any question on this? Now, let's now compare this with last in, first out. Even though that is not permitted, I will emphasize it again. I'm just showing you this in order to explain the reason why IAS 2 does not permit that. Okay. Let me eat this. Okay. Now, we made purchase on this date. And at a cost of 10 naira, an item of 1,000, and this gives us our cost as at that period. On this date, we issue item out of store because we sold the item. Okay, the quantity sold was 600, which will be issued out of store. At what price? Now there seems not to be a problem here because the only item we have here is this 1,000 units, and therefore we'll pick this price of 10 naira. Now I'll call it item of yellow. I'm picking from yellow items. Now, on the 7th of January, there was additional purchase. And what is the quantity? It was 400. And that gave me the new value. Increase in value of our inventory because of the additions. And on this date, 13th, we sold an item, 300 items. And these 300 items were sold from the last batch, not from the first batch, because it is last in, first out, which means I'll be selling this 300 out of this batch of 400. I'll call that my green batch, and I'm selling at what price? The cost of what I'm selling is 10.50 kobo at that price. Now, on the 18th, I sold additional item. And the additional item I sold is 400, which means first I'll sell from this last batch because it's last in, first out, which means I must exhaust the last batch before moving to the earlier batch. And from the last batch, what is left is 400. It's 100. What is left out of 400 is 100, which means from this batch of green is what I'm selling from. And it cost me how much? 10 naira 50 kobo. Which means what is outstanding as 14 is still from the first batch at 10 naira, which is what we are seeing here. Now, on the same 18, it is 400 to sell, but I sold 100 from the last batch. It then means that I can now proceed to the first batch to sell the difference between this 400 and 100 that was taken from the immediate last batch, which means I have to take from this yellow batch to meet up with the sales demand. And at what price? It's at 10 naira, which is the yellow batch. Okay, now on the 20th, I made additional purchases at the price of 10 naira. How many units? 10 naira 45 kobo. How many units? 500. Therefore, I can call this blue batch. Now, but on the 21st, I sold out of it, and the quantity sold is 300. But this 300 can only be sold from this immediate last batch. And therefore, I sold the 300 from the batch of blue. And at what cost is that batch of blue? Then I have 45 kobo. Which means the 300 that is left is 200 from the batch of blue and 100 still outstanding from the batch of yellow. Okay, now on the 27th, I purchased additional item at the price of 10.5 kobo. What quantity? 200. And that I could call it the batch of orange. Okay, and of which on the 28th, I sold 300. But this 300, I first met it with the last in, which is the batch of orange of 200. And the balance to make up 100 will be gotten from the batch of blue, because the blue still has 200 left in it. Okay, and which means this first one is satisfied from the batch of orange, and the second 100 is satisfied from the batch of blue. And that is what it is at this point. At the end of the day, what do we have? What we have based on, okay, I've not put the price. The price of batch of orange is 10.55, and the price of batch of blue is 10.45, which means at the end of the day, the 200 that is left is from 100 left from the batch of blue, because we have only taken 400 from the 500, and 100 left again from the batch of yellow, because we are only able to take 900 from 1,000. And that gave us an average price of 10.23 kobo, which is made up of 10 naira for the first batch of 100 and 10.55 kobo for the next batch of 100. 10.45 kobo for the next batch of 100. And that is what we've seen. Invariably, what do we have? We have this as our inventory value on the basis of last in, first out. Now, what can you see in this case is that if you compare this Okay, how many items here? This 2,1. How many items here? This 2,000. How come here is 19? No, how many items have we sold so far? 6, 300, 400, yeah. 300, okay. Let me eat this. Check. The 600 was met. The 300 was met. This 400 was met. Okay, 300 was met and this. Okay, let's check our total figure here. It seems that's what is not counting. This 19. This 19. Okay, it's from our first in, first out that I think we've overcounted 2,000. Yeah. How do we get it? This 1,400, 300. Therefore, there's none here. This has been, there's none here. We have oversold the item. This is what it is. Okay. Because all of what we purchased is 2,100 units, and all of what we sold is 1,900 from the question. Okay. And the same thing there, 2,100. And what we sold out is 1,900. Now, what you are going to see as a difference is that because of rising prices, what is it? You find out that prices rise over time. Because from the economic perspective, inflation is part of what brings about economic growth and development, but it must be persistent. It's not skyrocket. Okay, and that's why you find out that the price of items, no matter the condition of economy, will always be increasing in amount. And what that presupposes is that at the end of the day, if you have used LIFO, you will have your inventory value highly understated because of what? Bulk of item in your inventory will be from your first set of batch of item, not from the latest batch of item, which then means that your cost of sales will have been overstated and your inventory value will have been what? Understated. Do you get what I'm saying now? And in that case, such is not permitted by the standard. And that is why you find out that FIFO is not permitted because it will understate over a long period of time. And it doesn't reflect the economic reality or commercial sense in your transaction. Why will you keep stock of item from your first batch when it can even get spoiled, it will expire, and all sorts of things? Whereas you are not selling from the most recent item. The logic is that you sell from your earlier item so that you push them out first before your most recent item. That also accounts for the reason why LIFO is not permitted. Any other contribution or question before we forge ahead? Any question? Comparing FIFO and LIFO. Okay, now let's compare them with weighted average. Let me eat this. Now the cost formula is weighted average cost. Okay, now let's start. For weighted average cost, we start with our purchases. We purchase at 10 naira. How many quantities? 1,000. Okay, on the 5th of January, we sold how many quantities? 600. Now, weighted average cost is so straightforward that it just picks the weighted average amount here, which means weighted average cost is used for commingled products. Products that are not separately identifiable. Who can give me an example of a commingled product in which are not separately identifiable from one another? Who can give me an example? Who can give me an example? Who can give me an example? No one? No idea? Okay, let me give you a clue. Petroleum products. Foodstuff like gari. If you are the manufacturer of gari, how can you separate one gari from another? Petroleum products. Things that can be commingled, where you cannot say, okay, this is the first batch, this second batch, because they are of the same, it's not packaged in that sense to say this is this. It's like if you are in a petrol station, you understand, how can you separate the old stock? Because before it finished, they pour another one, it commingled to one another, is a mix of items. And in that situation, such items are encouraged to use weighted what? Average. Okay. Now, let me show you this so that we can read from that. When is it appropriate to use weighted average? I want somebody to read this out for us. Let me try and enlarge it. Okay, can somebody read this out for us?
Okay, so when should you use the weighted average cost method? The weighted average cost method, like any costing systems, will have disadvantages and advantages for different businesses. However, the weighted average cost method may be particularly useful for businesses where tracking the cost of individual units is difficult, or where individual units of an SKU are indistinguishable. You may also consider using the weighted average cost system if the cost associated with your business raw materials fluctuates often but stay within a reasonable stable price bracket. In addition, weighted average cost method may work well for your business if you tend to purchase inventory stock on a regular basis. The simplicity of the average costing system means that minimum maintenance is required. In effect, the transactions do the maintenance The transactions do the maintenance, and therefore this method tends to provide more accurate cost calculations, which may otherwise require staff time to track on an individual basis. Okay, which type of businesses benefit from the weighted average cost method? Certain businesses are particularly suited to adopting the weighted average cost method. Manufacturers, for example, can benefit from the method since their inventories are often stockpiled or intertwined, making it difficult to differentiate between older and newer items. Agricultural businesses also often benefit from the weighted average cost method because any product that is grown in a field and mass harvested cannot be accounted for individually. In the same way, many animal products are also stored in larger quantities and similarly cannot be differentiated individually. Okay. Fuel companies will also benefit from adopting the weighted average cost method since the product is stored in large quantities and batches cannot be differentiated from one another. Likewise, pharmaceutical companies will also benefit from using this method.
Okay. Any other question? Any other question? Okay, if there's no question, now let me go back to our workbook. Now, what happened is that at the end of the day, what you are saying is that the average item will be commingled together and average or weighted average price will be obtained. And the easiest way to obtain the weighted average price is what is here in this column, which means you will pick the weighted average price at the point of selling, which means the weighted average price that is picked here, it is this one. Let me just show you here. I'll use color to pick it up. I'll call this the yellow, which means I'm picking the weighted average price prior to the issue out of stock. Okay, now additional items were purchased for 10.50 kobo and the units is 400. Therefore, we have gotten another weighted average price, which is 10.25 kobo. Now, at the point I've sold an item, I sold item of 300. The price I'm going to pick is the price immediately as weighted average obtained at this point. And what is it? It's 10 naira, 25 kobo. Now, again, on the 18th, I issued out 400. The 400 I issued, we still have this price at what price? At the 10 naira, because there's no new purchases that will have varied the price. Okay, I can still see it here. I can put it at deep green. Now, on the 20th, I made purchase at a price of 10.45 kobo. The units was 500. Okay, and on the 21st, I sold item of 300 out. And what is the new weighted price? It's 10.42 kobo. And on the 27th, I purchased the last batch at 10.55 kobo. How many quantity? 200 in all. And of which on the 28th of January, I sold 300 quantity and the last weighted price is 10.47 kobo. Does that make sense? Does it make sense now?
Please, can you show me how you get those average prices? If you can just click on
Average price is what you can see here as the is dividing the kind amount with the quantity.
Okay.
Do you can see now? That is, okay, let me pick after I've purchased this for 2. You know, out of 1,600 has gone, Abi?
Yes.
Okay, the quantity left as at 7th of January, 2021. What is the average quantity? The average quantity is, I have, out of this 1,600 has gone, Abi?
Yes.
400 is left. And there's this new 400 that came in.
Okay.
Now, what is the price of this one? 10 naira. What is the price of this one? 10 naira, 10 kobo. What is their value? Cost price. What is the value? Or what is the cost in total?
Okay.
Is a product. Is that not?
Yes.
Now, what is the sum? At every time you purchase, your cost, your average cost will vary, will change. Now, what is the average cost? Your weighted average cost is now the difference, divide 8 naira 20 kobo with 800. And that gave us this 10. And that is this 10 you are seeing here.
Okay.
Okay. Let me put that color. I'll do it for others so that you can see it, which means if you understand the way it works, you won't need to be doing this every time. I'll do the same thing for when last I purchased was 20th, Abi. On the 20th, remember, as at on the 20th, out of this 1,000, let me assume that I've sold 600 and 100, which means everything has gone. You can say now, what I'll now do at the end of the day is to assume that, okay, out of all of these prices, I've sold certain amount. And the amount I've sold out of it was, as at the time I sold those amounts, what was the cost price? I'll show you now. I want to do it in a simpler version for you. Let me just pick this quantity so that it won't look complicated for you. What are their prices? Okay, now out of this item, you've sold how much? Out of this, you've sold these values. How many quantity have you sold?
600.
Let me pick it one by one so that you get what I'm doing. You sold out
600.
600. You sold out 300. You sold out what? 400 prior to that date, which means what is left? Is 600, which is this 600 you are seeing here. Now, what is the value of what you have sold out? Remember, when we sold this out, it was 6,000, have you?
Yes.
When we sold this out, it was what? This. And when we sold this out, it was this, have you?
Yes.
At the end of the day, what is left? Therefore, what is the price here? The weighted average. That is this 1042, which is a B. Which means instead of repeating these processes, which I'll repeat for the final one, final one was on the 28th. No, on the 27th. Now let me pick it one by one. What's the total quantity you purchased? 1,400, 500, 200. At what price? 10, 1050, 1045, and 1055. Okay, how much did you sell out? 600, 300, 400, 300. Okay, which means that is this 500 you are seeing here. Now, at what value? 6,000, 3075, 41, and 3125. And what do you have? 1047. Does it make sense now?
Yes.
That is what we are saying. That is what weighted average tries to achieve. Is that okay? Now we've seen the differences with everything all. You now find out that it is only FIFO that seems to understate the most the value of inventory. You could see LIFO understate the most. FIFO gave 21,110. Weighted average gave 2094, while LIFO gave 2045. You could see the reason why, because it's understate the value of inventory the most. And also, it does not reflect the reality of how inventory will be issued out of store. And therefore, I'll put up my stroke here, where I'm going to stroke it as not being permitted. I'll put it there for us so that nobody miss it out, that this is not permitted under no circumstance. Any other question? Before we move further. Any other question?
Excuse me?
Yes.
So I just want to ask, I don't mean to digress or to, so if we are giving this kind, when we want to do audit, they'll give us this kind of schedule and we just need to recompute to check whether it's been properly done. Is that how it is done in audit?
Okay, in audit is that you first of all obtain what is the accounting policy of the company. Okay, do you can say now, what is the accounting policy of the company? And the accounting policy of the company will tell you whether they use FIFO or LIFO, okay? And on that premise, you do your own inventory counts, and you also get supporting schedule to show what are the new purchases, what are the sales and everything. You now do your independent computation to see whether it's aligned with their own inventory value on the system. You know, there's what we call walk through the computer or walk around the computer, and also models you use in the course of audit. You can say now. And your own is to establish one, the physical presence of those items. That is the first thing you want to establish. The second thing you want to establish is that those items have been appropriately valued based on the appropriate cost formula. Okay, it is when you have identified your cost formula before you now move further to say, okay, the cost formula you have adopted, given that it's okay, the question then is compare it to the net realizable value. Is it C higher? Okay. And if so, you need to jettison the cost formula and value it at the net realizable value by way of recognizing a form of write-off. That's the implication.
Okay, thank you.
Any other question? We have auditors inside this session. Do you want to give us further guidance? We have auditors. Our auditors are not talking today. Why? Okay, that is that. Okay, let's move further to our other discussion here. Now we have discussed that. Now specific identification is adopted for peculiar inventory that are of significant value. Example, can you use FIFO? Can you use weighted average for inventory of aeroplane? Can you use it for inventory of Rolls Royce? Can you use it for inventory of gigantic ship? All of these are based on specific identified price, because you can specifically identify what is their cost. And as I provided they still remain in the inventory, you know their cost, rather than using first in, first out, and using weighted what? Average, which means that you must take that into consideration. Therefore, on that premise, I'll give you this to say the cost formula is a function of certain things, which we have also seen today. But in wrapping that up, I want somebody to read this and we'll move further to how do we value inventory?
Okay. Cost formula. Where inventories consist of a large number of interchangeable, that is identical or very similar items, the cost of inventories should be assigned by using the first in, first out, FIFO, or weighted average cost formulas. The LIFO formula, last in, first out, is not permitted by IAS 2. Where individual items of inventory are segregated for a specific project, specific costs should be attributed to those items of inventory.
Okay, thank you. Now the question is, how is inventory valued at each reporting date? Who can give us a clue? Who can give us a clue? Who can give us a clue?
Okay, based on what you told us earlier, that inventories are valued at the lower of costs and net realizable value. So the cost is what we've already computed earlier. So we also compute the net realizable value, which is the difference between the cost of the inventory minus cost to sale, and or cost to sell, and the lower of the two will be the one that will recognize at the reporting date.
Okay, who else? I've not had this voice today.
You have heard my voice.
Okay, I want to hear your voice again.
Honestly, I share the same idea with what Shegun just explained. As a matter of fact, having adopted any policy, any company policy to value inventory, we are going to establish the inventory cost as at the end of the reporting date. Then we compare it with the net realizable value, whichever is lower. That's what we recognize as the cost of inventory as the reporting date.
Okay. Now, which then signifies that inventory should be valued first at cost. And where it is observed that the net realizable value that is the fair value of the inventory, which is the market price, less cost to sell, or what we call cost of disposal, is lower the later, which is the net realizable value, will be adopted as a surrogate to cost. Hence, that is what forms the basis of valuing inventory. That's the conclusion that says inventory should be valued at the lower of cost and the net realizable value. Does that make sense now? Okay. Now, let us discuss extensively on net realizable value. I want somebody to read this out and see beyond just the market price of the inventory, less cost of sales. Can somebody read this out?
Okay. Net realizable value. Inventories should be measured at the lower of cost and net realizable value, NRV. In the costs of inventories, NRV could fall below. In the case of inventories, NRV could fall below cost when items are damaged or become obsolete, or where the cost to completion have increased in order to make the sale. In fact, we can identify the principal situations in which NRV is likely to be less than cost. That is where there has been an increase in cost or a fall in selling price. B, a physical deterioration in the condition of inventory. C, obsolescence of products. D, a decision as part of the company's marketing strategy to manufacture and sell products at a loss. E, errors in production or purchasing. A write-down of inventories would normally take place on an item-by-item basis, but similar or related items may be grouped together. This grouping together is acceptable for, say, items in the same product line, but it is not acceptable to write down inventories based on a whole classification, e.g. finished goods, or a whole business. The assessment of NRV should take place at the same time as estimates are made of selling price, using the most reliable information available. Fluctuations of price or cost should be taken into account if they relate directly to events after the reporting period, which confirms conditions existing at the end of the period. The reasons why inventory is held must also be taken into account. Some inventory, for example, may be held to satisfy a firm contract, and its NRV will therefore be the contract price. Any additional inventory of the same type held at the period end will, in contrast, be assessed according to general sales prices when NRV is estimated. Net realizable value must be reassessed at the end of each period and compare the gain with cost. If the NRV has risen for inventories held over the end of more than one period, then the previous write-down must be reversed to the extent that the inventory is then valued at the lower of cost and the new NRV. This may be possible when selling prices are falling in the past and then risen again. On occasion, a write-down to NRV may be of such size, incidence, or nature that must be disclosed separately.
Okay. Now, that has explained to us the fact in this case. Okay, and we've seen that these are the instances where it's likely that our cost can be higher than the net realizable value. Okay, and that is where you have yourself in this position. Okay, now let's move further to have some other deliberations. How do you recognize expense? In your books for the inventory that were sold, even though most of us have always come across it to say your gross profit is your revenue less cost of goods sold. Okay, but how do we recognize that in its real sense? Let's pick it one by one. Recognition of an expense as it relates to inventory. Can somebody read this out and let me explain one?
Recognition of an expenses as it relates to inventory. The following treatment is required when inventories are sold. A, the carrying amount is recognized as an expense in the period in which the related revenue is recognized. B, the amount of any write-down of inventories to NRV and all losses of inventories are recognized as an expense in the period the write-down or loss occurs. C, the amount of any reversal of any write-down of inventories arising from an increase in NRV is recognized as a reduction in the amount of inventories recognized as an expense in the period in which the reversal occurs.
Okay, now let's pick it one by one. The carrying amount of inventory is the amount of that inventory as at the point in which purchases is made. And that amount is what will be charged as an expense by way of cost of goods what sold, which invariably we can also call cost of what sales. Okay, that is number one. Number two is that when your cost is 10 and your NRV is 9, invariably what you are trying to do is that you are reducing invariably you are reducing your inventory value by 1, which will be write off into cost of goods what sold. And that's why when you see the breakdown of cost of goods sold, I have things like, let me say you are into petroleum product sales. You say your cost of goods sold, you see cost of goods sold for PMS can be this, cost of goods sold for AGO, diesel can be this, cost of goods sold for DPK, kerosene, might be this. And you now see things like write-off. And that write-off can be, let me say, 3. And what this means is that you have successfully expensed the amount of losses, which is synonymous to impairment losses on the inventory. You have written it off to your profit or loss through your cost of goods sold. And invariably, this will be 473,000, which will be matched with your revenue to arrive at your gross profit. And lastly, peradventure, in subsequent period, your net realizable value reverses. Okay, such reversal will be recognized, but to the extent that it does not exceed the original cost of the inventory if the initial write-down was not done. And it then means that such a write-back will reduce your cost of goods sold, which means write-off will increase, while reversal will reduce, which means it's a thing of positive or what? Negative impact on the amount of your original cost of goods what? Sold. Any question so far? Any questions so far? Now, let me give you this practice question. You solve it among yourself, and we'll come back and provide solution to it. I'll give you 5 to 10 minutes to discuss it amongst yourself, and we'll come back to look at it together. Okay, over to you guys now to deliberate on this for 5 to 10 minutes before I provide my suggested solution. Okay, what's your position now?
Okay, our position is that from this this little schedule, it is possible for us to compute our cost of inventory for each item, both A and B, and also to compute the selling price, which is what is shown as expected selling price. And we can also compute the selling cost, that is the cost it takes us to sell the inventory. So in computing the cost of inventory, we say we are going to multiply the raw material costs by the number of units separately from the attributable production overhead costs by the number of units. We then sum the two together to give us the cost of inventory. For example, let's take item A, for example. The cost of inventory will be $160 times 300 units plus $15, which is the attributable production overhead, times 300 units. So the summation of the two will give us the cost of inventory. Then the selling price, which is the expected selling price, will be $185 times 300 units, which will give us the expected selling price. So if you want to get the net realizable value, it will be expected selling price minus attributable selling price of $12 times 300 units. So the amount to be recognized as the value of inventory will be the lower of the cost that we have initially computed and the net realizable value.
Now, are you going to do it on a global basis or on an item by item basis?
We are going to do it on item by item basis, which is item A and item B separately.
Okay. Now let's compare what we have here. Now, what we have here is this. The cost here is 160 plus 15, which is 175, which is the cost price per unit. And here is 60. But net realizable value is deducting from the selling price the attributable selling cost, which is 173, being the difference between 185 and 12. And, sorry, this 173. And 65, which is the difference between 75 and 10. Now, on an item by item basis, not on a global basis. When we say item by item, we are not saying unit by unit. We are saying class of or nature of item. let us say motor vehicle is one class of item, motorcycle is another class, bicycle is another class. I get what I'm saying now. And that's what we mean by item basis. And in that case, the lower here is 73, which is the net realizable value, while the lower here is cost, which is 60. Now, on that premise, we'll now value this inventory, which means 173 times 300 and 60 times what? 250 will give us this amount respectively. And I believe that is all what you guys also have agreed upon. Is that okay?
Yes, sir.
Okay. Now,
Okay. I think we need a little clarification as per this solution.
Yeah.
Why do we have to sum up raw materials cost plus overhead before we multiply by the units?
Whether you
go by... Yes, please go ahead, sir.
Whether you sum it up or you do it individually, you get the same answer.
I thought when I computed it, the solution, the answer was different.
No, I just tried it. Same answer.
It can be different. There are law of arithmetic now.
Okay, Shegun,
300 times, just wait, 300 times 160.
Okay.
Plus 300 times 15 is the same thing as saying 300, which is the common factor, times the sum of 160 and 15. You get the same results.
Okay, okay.
Okay, now we'll close it up with this. We reiterate the objective of this standard once again, and we'll close up with the disclosure requirement. Who can reiterate the objective of IAS 2 again?
Okay, objective of IAS 2. The objective of IAS 2 is to prescribe the accounting treatment for inventories. It provides guidance for determining the cost of inventories and for subsequently recognizing an expense, including any write-down to net realizable value. It also provides guidance on the cost formulas that are used to assign costs to inventories. Should I continue?
Yes, disclosure.
Disclosure. Required disclosure, IAS 2, paragraph 36. 1, accounting policy for inventories. 2, sorry, just a moment. Okay, 2, carrying amount generally classified as merchandise, supplies, materials, work in progress, and finished goods. The classifications depend on what is appropriate for the entity. 3, carrying amounts of any inventories carried at fair value less cost to sell. 4, amounts of any write-down of inventories recognized as an expense in the period. 5, amount of any reversal of a write-down to net realizable value and the circumstances that led to such reversal. 6, carrying amounts, carrying amount of inventories pledged as security for liabilities. And lastly, cost of inventories recognized as expense, cost of goods sold. IAS 2 acknowledges that some enterprises classify income statement expenses by nature, materials, labor, and so on, rather than by function, cost of goods sold, selling expense, and so on. Accordingly, as an alternative to disclosing cost of goods sold expense, IAS 2 allows an entity to disclose operating costs recognized during the period by nature of the cost, raw materials and consumables, labor costs, other operating costs, and the amount of the net change in inventories for the period. IAS 2, paragraph 39. This is consistent with IAS 1 presentation of financial statements, which allows presentation of expenses by function or nature.
Thank you very much. Okay, in addition to that, I want you to read this. And that is borrowing cost. And why, to some degree, borrowing cost may not be taken as part of cost of inventory, and to some extent, it could be taken. But we'll discuss that extensively when we get to IAS 23. But before then, kindly look at it and also reiterate for the last time some element of cost that will not be included as cost of inventory. Okay, over to you. Anne, can you read?
Oh, okay. Borrowing costs, IAS 23. Borrowing costs identifies some limited circumstances where borrowing costs, that is interest, can be included in cost of inventories that meets the definition of a qualifying asset. With reference to IAS 2 to 17 and IAS 3 paragraph.
IAS 2 paragraph 17 and
I didn't hear you. Paragraph, yes, 23 paragraph 4. Okay, thank you. Inventory cost should not include the following. Reference to IAS 2 paragraph 16 and IAS 2 paragraph 18. The following are: 1, abnormal waste; 2, storage cost; 3, administrative overhead unrelated to production; 4, selling costs; 5, foreign exchange differences arising directly on the recent acquisition of inventories invoiced in a foreign currency; 6, interest cost when inventories are purchased with deferred settlement terms. The standard cost and retail methods may be used for the measurement of cost, provided that the results approximate actual cost. Reference to IAS 2 paragraph 21 to 22. For inventory items that are not interchangeable, specific costs are attributable to the specific individual items of inventory, with reference to IAS 2 paragraph 24.
Okay, thank you very much. Any other question as we bring all of this to close? Any other question?
I have something to ask.
Okay, what is it,
Hello,
madam?
sir.
Yeah.
You made mention of buffer inventory. I did excuse myself, but so I don't know if we have said something about it.
Okay, no, we are going to discuss something about buffer inventory when we get to IAS 16, which is the next discussion we'll have. Okay, but what do you mean by buffer inventory? Okay, or what we call buffer stock. Okay, buffer stock is a stock that you have to maintain minimally to ensure that the condition of the plant or of the pipeline or what you are using in order to store or to convey or to transport such level of inventory is maintained at all points in time in order not to more or less be detrimental or to affect the functionality of that plant or pipeline or storage tank, as the case may be. Now, let me break it down into something you can relate with. For example, let's pick our pipeline at home, your tap. No matter how there's no water, when you break those pipes on the ground, you see that you see minimum level of water there. That is why you find out that when you open your main tank, not quite to 1 or 2 seconds, water is already flowing in your house. Do you know why? Because the water that you release from the major tank will push the one that is there as a reservoir first. And that's why you see that it's getting to you immediately. Not like it's taking time, because there are some level of water there that is sitting there as a sediment. Do you get what I'm saying now? And that's what we call the buffer stock in that case. Now, this is maintained in most cases to ensure that that plant or that, what's it called, pipeline or something is not damaged, is not rusted, is not having defects in its nature. Do you get what I'm saying now? And the reason why also some have it there is not because it protects the functionality of that plant or pipeline, but rather for storage purposes, in anticipation that there will be scarcity, or in anticipation that you might not have raw materials or new stock so that you can be able to profit more. The question then is, we need to distinguish between buffer stock that is held for the sole purpose of meeting future demands from buffer stock that is used to enhance the functionality of an item of property, plant, and equipment. If it's a buffer stock that is treated solely for the purpose of meeting future demands, to having minimum quantity in order to satisfy demand in case of stock out, such will be treated as inventory. But if it is to maintain the functionality of another asset, which constitutes item of PPE under IAS 16, such will be treated as a component part of PPE. Does that make sense now?
Yes, it does. Thank
Yeah.
you.
Okay. Thank you very much.
Yes, sorry, you've not explained what merchandise inventory means for us.
I think we've discussed that. Even Shegun was the first person to explain it.
Oh, okay. I thought it was it was his own opinion. I don't know that we adopted.
No. Okay. Merchandise stock are stock that we know as stock, where you buy and sell. You are not adding any value to it. Do you can say that I buy it and I sell? I'm not buying it as raw material that I will convert into another form to sell. No. I buy motor vehicle, I sell motor vehicle. I buy wristwatches, I sell wristwatches. I buy clothes, I sell clothes. It's different from I bought material of clothing and I sew it. Yeah, two separate things. This one is ready-made. I bought it, I sell. You understand? Those are what we call merchandise stocks. Is that okay?
Perfect. Yes, yeah. Very okay.
Any other question? Okay, this brings us to the end of this chapter or of this section. Thank you very much on that. In our next sections, we'll be discussing on other things that might have bearing with inventory. Some of them is IAS 16, property, plant, and equipment. Some is IAS 41, where we'll be discussing on agriculture and biological assets. Until then, thank you very much, and God bless you.